Hey there, it is Corey here from Verse. I hope that you and your family and your friends and your community are all going well. We are here for another market update, and I have my counterpart, one of the other financial advisors here at Verse, joining me, Ashley Bishop. Ashley, welcome to the session, and nice to see that you have rugged up like most of us down here in Melbourne.
Morning everyone, and morning Corey. It's certainly colder this week than it has been for a while, so it feels like winter has truly arrived early down here in Victoria, at least.
I think with your heritage, being a Kiwi and in part from the UK too, you're born for the weather, mate. You should be very comfortable.
Comfortable is one way of putting it. I've been here for 6 years, so maybe I've gone a bit soft.
Sure, fair enough. Now, let's dive in. So in terms of today, we want to cover 4 key questions that many of you are asking, common questions that we're getting as well in our conversations with you. These questions we're going to cover, and largely it is me firing the questions to Ash here. Question number 1 is, why are markets rising when economies are falling? Number 2 is, in terms of financial markets, have we got through the worst of it? It is now a little while since we saw those lows on March 23, and we've had a strong rebound since then. The third question is, why is the US so important in terms of its impact on our portfolios and superannuation funds? And finally, why is trying to time the market almost always a bad idea? And we've got some great, really valuable data to share with you to illustrate why timing the market or trying to time the market is normally fraught with danger. Before we do dive into those questions, though, just a bit of an update as to what we saw this week. So firstly, at home here in Australia, that is, we are seeing a lot of positivity, as you all well know, in terms of how we are combating and managing the COVID-19 health crisis. We are beginning to see the relaxation of some of the isolating regulations in some of the states. Not so much in Victoria just yet. We're a little more conservative than most, but we are beginning to feel like returning to something close to normal life is going to come much sooner than we anticipated. I was on the couch yesterday afternoon for a short break and saw a bit of Scott Morrison's address, and he is talking along similar kinds of lines and really pushing the fact that there is going to be a real easing of these restrictions very soon. We did see the end of April come and go, and that was in fact the best month on the Australian share market in 32 years. So since 1988. That is, we have said in recent times that the best months tend to follow the worst months. That is a really good example. We did see our market close down almost 5% last night on Friday afternoon, and the potential return of some higher levels of volatility. That was largely driven by some of these substantial job losses we have seen over in the US. In terms of the US, this week there were some positive developments around a potential vaccine to help combat COVID-19. Dr. Fauci, who at the moment is Trump's right-hand man, was talking about a drug that has been proven in the trials they have done so far to expedite the recovery from COVID-19 from 15 days to 11 days when compared to a placebo. And Bill Gates in the last couple of days has been talking about the possibility of maybe having a vaccine widely available within 9 months. So that's been pushing their market higher. Their market has continued to rally off those March 23 lows that we have spoken about. Their market is in fact 27% higher than it was on March 23, and now just 13% below the lows, which were in fact record highs on Feb 19, which is kind of remarkable in the sense that in the last 6 weeks they have had more than 30 million Americans file for unemployment. Now, to give that a bit of context, throughout the duration of the GFC, the US had 8.7 million citizens file for unemployment. So they are seeing, in the span of 10 to 11 days, as many people file for unemployment due to COVID-19 as they saw for the entirety of the GFC. So the downturn they are seeing from an economic standpoint is beyond significant, yet their markets continue to rally, which does lead us to our first question for you, Ash. Thank you for being so patient. Which is, why are we seeing markets continuing to rise as we see economies stalling and falling?
Yeah, no, thanks, Corey. Happy to be patient. Ultimately, if you watched the video last week, you'll remember we talked about the difference between fear and optimism. So the reason markets dropped so significantly in many ways is because of the fear and uncertainty about what COVID-19 might bring. And the reason we talked about for rallies is because some of the optimism had returned to investors and to the market in general. And that's a big part really of why we're continuing to see a rally in US markets and around the world, is because, and like you touched on there, Corey, there's been a bit more optimism around the recovery in terms of finding a vaccine or finding drugs that help to expedite the recovery process. You're starting to see some states in the US move out of some of the social distancing restrictions that they've had, so they're looking to restart the economy. And markets in general are looking forward. So they're not necessarily worried too much about what happened in the past, though that does come into account. Realistically, what they're thinking is, what is the economy, what are the markets, what are these companies going to look like down the track? And that optimism about moving out of these sort of restrictions we've had around COVID-19 is a big part of the drive behind the recovery markets recently.
Is it possible that markets are maybe being a little too over optimistic in terms of what that recovery might look like?
Yeah, look, absolutely. The key point here is that we're still in uncertain times. If we think of the news being relatively positive around the recovery and moving out of the restrictions we're in and eventually moving past this health crisis that we're currently in, that could easily change if we get some sort of bad news as well. So you mentioned Bill Gates, Mitch, said that there might be a vaccine inside, say, 9 months or so. But if the news comes out and says actually it's going to be 24 to 36 months, hypothetically, then that will be considered to be bad news, and you probably see more of a dip in the markets or more of a sell-off as well. Then the same, the real risk at the moment that's being talked about is the risk of a second wave of infections around the world, especially for countries and states, importantly, who loosen their restrictions too quickly. And if you start to see second wave of infections and deaths coming from those infections, then that's likely to be considered to be bad news as well, because that will inevitably lead to more restrictions and the economy will take even longer to reopen and recover, which will have an inevitable effect on markets.
That's probably a good segue into the second question that we had for you, which was in terms of financial and investment markets, have we gotten through the worst of it? It's now some time since those lows of March 23, US markets up 27%. Since then, our markets up 17, 18%. Since then, despite the falls yesterday, are we through the worst of it, or perhaps is there more to it?
Look, the short answer is no one knows. At the end of the day, the market has begun to price in that recovery. So they're thinking, maybe we are through the worst of it, and there are some good prospects for economic recovery, in particular in investment markets. Of course, as we touched on before, that could very easily change if the news turns negative in terms of our ability to get out of this current health crisis. And again, we're talking about second wave of infections, delays in vaccines, maybe the drugs that are being touted as being game changers, so to speak, in terms of the recovery from COVID-19 turn out to not be as positive as first thought. Again, the drugs that are being touted still have to be reviewed in many ways. So there is a long way to go in this crisis. Certainly the news has been more positive over the last few weeks, and that's been reflected in markets. But if that news changes, then that's likely to be reflected in markets as well. So the key point really is that we're probably looking at quite a bit of volatility over the next few weeks and months.
Yeah, I mean, volatility was at extreme levels there for a good kind of 4 or 5 weeks when things turned south in late Feb and into kind of middle March. Things have settled down a bit since then, but at any point in time, we can see that volatility spike again. We in line with what you're saying, Ash, we really have these competing forces at play that are trying to pull markets in different directions. So we've got the health crisis, but we have increasingly positive news and forecasting around the infection rate, the death rate. I think here in particular, but also many other places, some of the doomsday scenarios that looked likely 4 to 8 weeks ago haven't played out at some of those extreme levels that we thought. and we are seeing some positive news in terms of like vaccines and the like, as you said. On the flip, we are yet to see most of the economic data to tell us how bad things have actually gotten in that sense. We are now beginning to get some of the Q2 economic data, so April 1 to 30 June. Remember, this crisis didn't start until near the end of last quarter. So last quarter's economic data isn't really telling us too much. But as this data starts to come out, it's going to be some of the scariest economic data that we have ever seen, at least since the Great Depression in the early 30s. I know markets are factoring in the level of the scariness of that data in a sense, but if that is worse than anticipated, again, we might see markets fall to the downside. So I think prepare yourself for volatility is probably the key message. And we may go lower than those March 23 lows, but the longer in which we stay away from those lows, and now it's about 6 weeks, the less likely we are to retrace them. So
yeah, absolutely.
Plenty happening, and sorry, Ashton, and plenty of stimulus from governments and central banks that really have taken a whatever it takes type approach to keep their economies going and get them through to the other side in a way we haven't seen before. So there is a number of competing forces at play at the moment.
Yeah, absolutely. And ultimately, it's going to come down to in future about how you mentioned how reserve banks, or in the US, the Federal Reserve, or respective governments around the world treat the pathway to recovery. So, for example, if we're in Australia, is what does the government do with the boosted job seeker payment, which was the old New Start, the coronavirus supplement, what do they do with that? And the JobKeeper payment as well, which is having a real impact on keeping the unemployment numbers, which they're predicting to be 10%, but realistically are probably higher if you take away that JobKeeper payment. Decisions that governments are going to make are going to impact how the economy recovers, and is going to also impact how investors feel about the prospects for the markets as well. So there are plenty of risk points out there, but recently those risk points have been to the upside. So we'll see what happens going forward. But yeah, certainly expecting volatility is a sensible approach.
Next question for you is: we do spend quite a bit of time talking about the US. In terms of people's investment portfolios and the superannuation accounts, why is the US and what happens in the US so important?
Well, look, there are a couple of points on that. I mean, the most important one probably is that the United States, for all its faults and positives, of course, is still the biggest economy in the world. So any activity that happens in the US is inevitably going to impact the remainder of the world just because of that status alone. And then on top of that, in terms of Australia and the US, our economies, the way we run our governments are largely similar. And so our companies themselves are often impacted directly by US companies as well, or US, I guess, feeling and sentiment. So that correlation between our nations has a real impact as well. And we get lots of news out of the US because, again, the US is a democracy. It's a free and open media. We hear about what's happening in the US. We hear their politicians. We hear the arguments. And so on a day-to-day basis, given the nature of things right now, that can be very volatile. So investors consider all these things in a lot more detail when, if we compare that to someone like China, for example, where, in all fairness, it's probably not a fair and free and open society, we don't get the same sort of news coming out of China. We get a very specific message which has been approved by government. So it reduces the volatility from that messaging compared to the US. So there are lots of different factors there, but certainly the size of the US economy really amplifies what happens in the US compared to what happens on our investment markets.
Yeah, and in terms of that correlation, we do see that on investment markets. Certainly historically we have, and that's unlikely to change anytime soon. So the data set, in terms of this crisis, the data set coming out of the US is going to have a big impact on global sentiment, investment sentiment, and on investment portfolios as well. So when we say data set, we're talking about their infection rate, their death rate, their unemployment rate, their GDP, so their economic activity or slowdown. These things are all going to have a flow-on effect. And If these things are worse than is being anticipated, there's downside risk for the market. If these things surprise to the upside, then there's probably some upside movement to the market as well. And, I personally have my apprehensions about how the US as a collective and certainly in a political sense have managed the crisis. I think most of us feel the same way. Turned on the TV this morning and saw more protests in the US, saw hundreds of people, by the road in Santa Monica in California, no social distancing at play, protesting, the removal of their civil liberties. My partner Christy described it as foolish. I don't think there's any other way to describe it. And one of the risks at play here is that the US and some of their states, they push to reopen parts of their economy too quickly, and that slows down the recovery from COVID-19 and removing that risk. And the flow on and consequential effect is to the slowdown in the economic recovery for the US, and then in turn for others and investor markets as well. So something that we're all keeping a close eye on. Now, final question for you, Ash, is around timing of investment markets. So this is a question we get a lot of, and even in recent times, well, if markets might turn to the downside again, why don't we sell out now and get in later? So why is trying to time the market almost always a bad idea?
Well, it's a really important question, Corey. And I think the best way to think of it is if everyone who's watching this casts their mind back to mid to late March and around that March 23 period where we reached the lows of the market, having seen a 40% drop or so from the peak of the market. If you at that time had sold out of your portfolio and thought, you know what, this is too much for me, I'm going to get out and just wait and see when the recovery happens, you would have missed out on the last 5 weeks of a really positive recovery, and therefore your portfolio balance would be impacted. And that's realistically because you tried to time the market, and the market, as we've noted, is volatile. The sentiment and the feeling can turn really quickly, both up and down. But ultimately, just on a recent experience, trying to time the market would have proven to be really, really detrimental to your portfolio balance. And that does have a real impact on the remainder of your life. I think, Corey, you've got a great graph that you're going to bring up shortly. So maybe you could talk through this, but it really highlights why timing the market is not sensible.
Yeah, thanks, Ash. So what I've got here is a great tool from Fidelity. Fidelity is an Australian-based fund manager that has a history of strong performance when it comes to Australian shares, but also runs some global funds as well. Now, this chart here is from October 2003 through to April 2020. So it is about 17 years of graph that we've got here. What this is designed to do is to highlight the fact that if you were trying to time the market and you missed the 10 best days on the market during that period of time, how much of your returns would have you given up? So we can see here, using the Australian market as the example, if you invested $10,000 back in late 2003, if you had market returns, that balance at the moment after these recent and significant falls would be about 33,000. Prior to the Corona crash, closer to 44,000. If you had missed those 10 best days, your return falls down your balance falls from 33,000 to 19,500. So you have given up more than 40% of your returns over a 17-year period by missing just the 10 best days over that stretch. Now, in terms of missing those 10 best days, you would need to be out of the market for a long period of time to do that. Having said that, to miss a number of those best days, you don't need to be out for long. We mentioned the Australian market had its best month in 32 years last month. The US market had its best 30-day rally in 44 years up until a week and a half ago. So you would have heard me say, Ash say, our advisors say that the best weeks follow the worst weeks, the best days follow the worst days, the best months follow the worst months, the best years follow the worst years. So often, not always, but very often, because markets do get oversold when fear and panic finds its way and pervades its way into markets. So if we use the US here as another example, that 10,000, same time period, would now be about 38,000 pre-Corona crash. That would have been closer to 47,000. If you had missed those 10 best days, those returns fall by more than half. Your balance would be about $18,000. So you've given up more than 50% of your returns over almost 2 decades by missing just the 10 best days over that time period. If we made that the 20 best days over that time period, you have given up almost 75% of your returns. Quite staggering. So this data is to highlight and reinforce the fact that markets can rebound as quickly as they fall. Markets, when they're volatile, they're highly unpredictable, and for some people, moving to cash when markets are in that free fall, which is a really, it can be a stressful time. Moving to cash can seem like the safest thing to do, but it's almost always the riskiest thing to do, because it gives you the highest probability of not being there for the inevitable market recovery. And market recoveries are always inevitable. They have been, they will continue to be. As a human race, as a collective, we are a powerful and unstoppable beast, and we can be slowed down from time to time, but that's only ever short-lived. So that reinforces the fact, Ash, the point that you're making there, that timing the markets is never has been and never will be a great idea. So Ash, thank you for your advice and your thoughts this morning. There's been value in it for me, and I'm sure for all of our clients and their friends that are listening. So thank you for joining us. Enjoy the rest of your weekend. Hopefully you and your partner Di can stay warm.
We'll stay warm. Thank you, Corey. And, thank you for having me today. And you enjoy your weekend as well. And everyone out there, wherever you are, stay safe, stay warm if you're not in Queensland. And look forward to speaking to you next time.
Thank you, Ash, and thank you very much. If you have any questions about your portfolio or your financial strategy, please feel free to reach out. You know that we are here in the good times and in the tough times. I have said a few times in recent times that there has never been a more important time for people to get financial advice and have the right guidance around them. If you do have family or friends or colleagues or neighbors or people that you think would value getting advice from our team, please feel free to make the introduction. Below this video is a link to the Verse Client Referral Program. You can introduce someone in about 20 to 30 seconds. You pop their name and their email in, and we will send them a respectful and discreet email to introduce ourselves. And if they want to make some time for a 15-minute free phone call to talk about how we might be able to help, they're welcome to take that step. But in the meantime, enjoy your weekend. For those in Melbourne, stay warm and look after yourself and your family and your friends. And we will talk with you very soon. Take care.